So just how excited should you be about your portfolio in the new year? Well, recent economic data shows that the economy appears to be picking up. Will the market continue to follow that lead? Our next guest, Jim Paulsen, is Chief Investment Strategist at Wells Capital. He thinks the S&P will hit 1425 next year. Our co-anchor for the day, Citi's Tobias Levkovich, sees S&P at 1300. Welcome, gentlemen, both of you here. So, Jim, kick us off here. You believe that this economic recovery is sustainable. Why do you think the market's going to follow that lead?
Well, I think what we've been doing up till now in this recovery, Margaret, is the mindset of the consensus is that we have recovery, but it's highly susceptible to a double-dip recession. And that's kind of been what's been playing out this year. I think one of the things that's happening now, and it's going to get stronger and stronger next year, that's going to help both the economy and the market, is a generalized acceptance by the consensus of a sustainable economic recovery. That's a big step, and it does good things. Imagine a corporate CEO who's been worried about double dip all year, but now starts to see, man, this is going to be a 3 or 4 year recovery. He can expand his planning horizon, and suddenly staff additions make sense. His capital spending programs make sense. He's got to up his inventory policy, and that's going to all add to economic growth. I think job creation as a result of this is going to go from about 110,000 a month in private payrolls this year to maybe over 200,000 a month next year. And if we do that, that could do a lot to consumer confidence and spending trends. On the market front, I think it also does good things. We've been valuing the stock market as a whole, risk assets, cyclical sectors, with the idea of a potential high risk potential for a double dip recession. If we now start valuing it for a prolonged recovery, even if it's a slow one, you have a much higher valuation that you attach to those asset classes. I think that is the primary driving force that still is likely to play out in a better way yet in 2011.
So at least the worst is off the table. But that isn't the same thing Tobias is saying, you know, we've got only up to go. But talk to me about one of the things where I see the two of you different on in terms of worldview, which is that you don't necessarily think economic and business fundamentals result in higher stocks.
Actually, some of the things that Jim's talking about I agree a lot on, and that is that the credit environment is attractive, corporate confidence has returned, and in fact, that's what actually was telling us back in 2009 that things were starting to turn. The credit conditions have started to change. If you look at the Federal Reserve Board's Bank Lending Standards Survey, it leads economic activity by 9 months. So it's actually been a phenomenal lead indicator, both in the horrific environment we had back in 2007-08. But this is a global
environment. Then we had the sovereign debt crisis sort of throw us for a loop a bit.
But keep in mind, 70% of sales for S&P 500 companies occur in this country, not outside the world. And Europe's about another, call it 10%. Canada and Mexico are about another 10% combined, and then the rest of the world is the remaining 10%. So we're still very, very much a domestic economy, and what happens here counts more. Not that the other places are unimportant, but this is more important. So it's not really that Jim and I are that different on the economic outlook. I think some of that's already getting priced in. And I guess I would ask Jim, you know, Jim, at what point on the bond yield do you get nervous?
Yeah, I think that's a good question, Tobias. I think we're starting from very low levels. And I would suggest that we've got to get north of 4% on the 10-year before it really starts to bite into economic activity. I mean, I think it's a package of things. It's not just that bond yield. It'd be higher energy prices. It'd be a strengthening in the dollar. It'd be widening spreads, you know, most of which right now we don't have a lot of. I think the 10-year Treasury at 3.25% this morning is not much of a hurdle for this economy, nor the stock market. So I think that's another reason why I think we probably are going to push the market higher, 1,400, and that also will eventually lead to maybe 4% yield before the year is out.
Jim, we were talking earlier about some nervousness when it comes to the financial sector in particular. How do you feel about that in the new year?
Well, one thing I'd throw out, Margaret, is throughout the last 2 years now, every year we've had a backdrop where everyone's worried about the next Armageddon to hit.
Right.
And that's been the consistent, and I like the fact that that's still there going into 2000. Not as strong anymore, but it's still there. We're more concerned about what the next bubble to blow up. And we're finishing up our second...
So you're brushing off these concerns about the municipal bond market right now. You say don't worry about it?
I think so. That's what I'm saying as an investor. Now, I'm not saying that it isn't a problem. I'm not saying we aren't going to have continued problems. We're going to have high unemployment rate for years. We're going to have more foreclosures. We're going to have more bank failures. We're going to have municipality problems. But we're also going to have an ongoing recovery and higher markets, which is exactly what we did in the past recoveries. In the 1980s, we had a high unemployment rate throughout much of the decade. We had bank failures go up every year that decade almost, and yet we had a Reagan recovery which was very, very strong. So I'm not saying we don't have any issues or problems, but I'm saying it's been wrong for investors to be too driven and affected by those issues and being out of these markets. And I think it will be again in 2011.
All right, Jim, we got to leave it there. Thank you very much for coming on and sharing your view with us.
Thanks, you guys. Happy holidays.
Happy holidays.